This conference will now be recorded.
All right, so glad I remembered to start recording. We're starting Options 101. This is session number 2. We're going to start out with a basic review of some of the things we covered in session number 1. The video to session number 1 is available online in YouTube, and then we will go ahead and get started with this one. So if you don't have the link, I'll post it in the chat at the break, or I'll chat or at the end, so you can see it permanently out there whenever you want to look at it. And then this one we'll post in a day or so, and that will be available to everyone once I get a chance to edit it, or rather my daughter gets a chance to edit it. So without further ado, let's go. So I am a investment advisor. I'm a CPA. I'm a CFP. Do all kinds of stuff with money, but none of this stuff is investment advice. Yada yada yada. Your risk is your risk alone, and I don't take any responsibility for the trades you put on. So we're going to go through the basics. Talked about options last time. Basically, discuss what a put, what a call is. Discuss that there's a lot of reasons to trade options. Talked about premium being the amount that you pay to buy an option, or the amount of money that you receive to sell an option. Talked about options having expiration dates, I should say. We also have, every option has a strike price, the price at where you want to do business with someone. Options can be exercised, which means if you want to turn your options into stock or stock funds, you can do that at any time. Those are American options, as opposed to European options, which can only be exercised on their expiration date. So if you are the owner of an option, you get to exercise it. But if you are short the option, or you sold the option, or as we say, you wrote the option, you can be assigned on the option, which means that someone can at any time decide that they want to exercise their option. And since you have the obligation as the seller, you will have to either deliver the stock or become short the stock if you don't already own the stock. We're going to talk more today about in the money, at the money, or out of the money. That's going to become really important as we start to discuss particular trades with options. And of course, we're going to talk about intrinsic value or real value. And we also started talking about extrinsic or time value. And that's going to become more important in today's discussion as we get into the particulars of buying and selling options. We know options give you leverage, and they also help you with risk management and allow you the ability to hedge or reduce the overall risk of a portfolio. And basically can be a very effective tax planning tool. Obviously, the disadvantages of options is that whatever you spend on an option can be lost, but obviously that can be an advantage because you're defining what your risk is. So if you own an option, you don't get the dividends, and if you talk too much about options around your family, could be a good thing. They just start to avoid you. We talked about calls and puts. It's a legal agreement. So if you're buying a call or you're buying a put, you have the right, but not the obligation to exercise your right. But if you're selling a put or you're selling a call, you do have the obligation to deliver either the stock or the underlying instrument if you decide that you want to sell that particular option. Calls give you the right, but not the obligation to buy something. Puts give you the right to sell something if you are buying the put, and if you're selling the put, it gives you the obligation to buy a stock or an underlying at a particular price, regardless of where it might be trading at that particular time. So we talked about reasoning for trading puts. You're bearish mostly, or you want to make money from the downside. Talked about the rights and obligations of the put buyers. Obviously, if you're buying the the call or you're buying the put, you're paying the premium. And if you're selling the put or the call, you're receiving the premium. So one of the things to remember is that there are kind of 4 different actions that you can take with puts and calls or options. And it's either buying to open, so that's making the opening trade to buy a put or call. And when you buy something to open, at some point, at any time before expiration, you may have to sell to close that particular option. If you get to expiration and that put or call is worthless, then you don't have to do anything. On options expiration, which is on a monthly basis on the 3rd Friday of every month, those particular expired options will disappear automatically from your account by the brokerage firm. If you sell an option, we say you're selling to open, that's you're making an opening trade. And unless that option expires worthless on expiration day, at some point, whatever you sold to open has to be bought to close to finish off the trade. And variations on the sell to close and to buy to close is known as rolling options, and that's a little bit more of an advanced strategy that if we go that far, we'll talk about. But basically, all options that are out there that are open, we call that open interest. Those are the options that have not been closed at the end of the day and are still in traders' hands or investors' hands at the time. And every night, overnight, we get another tally of how many options at any particular strike and any particular expiration are still out there and open, and that's called open interest. Buyer of an option is option holder, seller is an option writer, and option contracts cover the obligation for 100 shares. So when we quote the price of an option, remember that we quote it in terms of a per share cost. So if you're buying a call for $3, it's $3 per share, and since you can only buy a contract covering 300 shares or 100 shares, the cost of the option is going to be $300. So when you hear low real numbers thrown around about the price of an option, always in your head think of, well, multiply it by 100, because I can't buy an option covering 1 share. I have to buy an option covering 100 shares. So when you see the prices of options, you see them quoted in terms of a per share price. Option premium, as we said, is the amount that you pay to buy an option or the amount you get for selling an option. We just talked about this. Some of the option pricing components we talked about last time. The main component that we're going to talk about today in terms of determining option prices is volatility. Okay, so besides the actual underlying stock or underlying fund that you have, volatility is one of the most impactful on the price of what you pay for an option. So paying attention to volatility when buying or selling an option is very critical to getting or putting the probabilities in your favor. Obviously, the time to expiration is also a factor, and also what strike price you choose basically goes into the pricing. So we talked about the strike price last time. The strike price is the price that you want to do business at. So if you're talking about Apple trading at 110 and you want to buy at or around 110, you want to buy Apple at or around 110, the strike price is where you're going to do business with Apple. And whatever strike prices are presented by the exchanges, that's what you get. You can't form your own custom strike price. This is an example of 50-cent strike prices. And then we go into options expiration, as I said, the third Friday of the month. Options volume, the number of options contract traded every day, open interest, the number of contracts that had not been sold to close or bought to close at the end of the last business day, and it only changes one time a day. And we talked about this being a critical component of your selection process in buying or selling options. You want to see open interest of at least 150, and if you see anything less than 100, you probably don't want to do business at that strike or at that expiration. Okay, so now we're going to start to get a little bit more into what we touched on last time and what we want to get into today to get you a little bit more up to speed on what you need to consider when you decide to buy or sell options. Okay, so what you pay for the option is exactly two components. The premium includes what's called intrinsic value plus the time value. Okay, and just flip that equation around and you can see that intrinsic value is basically premium and time value. And not a lot of people use the terms intrinsic or extrinsic value, but when you think about intrinsic value, we're talking about real value of the option. So when I switch over to the trading platform, you'll see the intrinsic value is what is the option really worth relative to the underlying. The time value is just that. What do you get in terms of the amount of time that you're buying or paying for or selling when you buy or sell an option? So every option has a time value and an intrinsic value. And a lot of time, the intrinsic value will be zero. So we'll get into that a little bit more in a couple of seconds when we switch over to the trading platform. Okay. The intrinsic value of an option contract is the value of an option with no consideration of time. So if you're buying an Apple call at 110, see if I can draw on the screen here, and Apple is trading at 111, what this means is that you are buying a call that has $1 of extrinsic value. And why is that? So if the 110 call while Apple is trading at 111 has a dollar value, you're basically taking where Apple is trading at 111 and you're subtracting it from the strike price at 110. So think about it this way in terms of figuring out intrinsic value. Intrinsic value, again, is real value. The real value of Apple is 111. So if you wanted to go out and buy or sell Apple, you would have to pay, or you would get $111 for Apple. Your particular option at a 110 strike would probably be trading for at least $1. Okay, and we'll see that on the screen in a moment. And so the 111 price that it's trading at minus the strike price 110 tells you that that option has $1 of real value. Now that option might be worth $2, in which case $1 is real value and $1 is time value. Okay, so intrinsic value is just the real value of an options contract. Okay, so let me switch over to the platform and just kind of go through some of this, and we'll just bring up Apple as an example. Very simple. And just to kind of refresh everyone's memory, I'm going to hide the chat for a second here so I can see my full screen? All right. So just to refresh your memory about what we're seeing here, this is, you're looking at the options chain for Apple. This is where Apple closed the day yesterday, 113.02, down 377. And these are the basic stats. You're looking at thinkorswim, the thinkorswim platform. And most trading platforms show you kind of the same things when they're looking at, when they're showing option chains, as we call them. They're called options chains. And what you're looking at here with these little carrots, obviously, are all the various expirations of Apple. Let's see if I can get my drawing tool highlighter to or spotlight to show up. So you're seeing all the various expirations, and what you're seeing here is basically these options that expire next Friday. So these are weekly options. They are in yellow, and the monthly expirations, which you're seeing the date of expiration, 16 October 20. That's a regular monthly options expiration. The number 13 in parentheses gives you the number of days till expiration. And then the 100 means that these are the regular sized option contracts covering 100 shares. All right. So every platform kind of gives you the ability, and let's see, to control what you see on the screen. I'm going to go to the regular October expiration, which is in 13 days, or just about 2 weeks. All right. And so you can see the layout, and you can see my custom layout is very busy. And if I close down this panel here, you can see I choose to display, I've customized this presentation to show a lot of different factors that I like to see. And I'm going to shrink that down to just a few components that are critical for our discussion. I'm going to open this back up a little bit. So in this particular presentation, the platform should supply you with several standard layouts of looking at option chains, and you can obviously customize your own in most platforms and choose what columns you want to show in there, so that when you're looking at any particular option, and as far as what components are critical to you, you can see them on the screen. So when you're showing those, you can also reduce the number of strikes that you're looking at. And so in the case of Apple, because they recently had a split of the stock, you're seeing strikes that are like $1.25 or $2 in width. And that's simply a factor of, these used to be $5 wide strikes prices, but with the 4-for-1 split, that reduced the strike prices to some odd numbers that you see here. And you're going to see those all the way through all the expirations until all those old expiring options roll off the board that were affected by the split. So you can display as many strikes as you want, and you can actually type in how many strikes you want to see. Recall also that if you can see it on your screen, we talked a little bit about in the money and out of the money. I'm going to talk a little bit more about that in a second. But the shaded area, if you can tell, is the ones that are in the money on the call side. And here on the put side, get my spotlight back out here. Here are the puts, here are the calls. And you can see down here that all of these are in the money because they are shaded, and these are all in the money on the call side. And we'll talk about that in a sec. So Apple closed yesterday at 113.02. So what we would say is, let me drop this down, because as soon as I clicked on the option bid or ask, I assumed I wanted to place an order, and it brought up the order form. You can see here that at the money means where the stock is trading. So when you hear the phrase at the money means where the stock is trading. Well, it's trading at 113. And just so happens that we have a 113 strike available to trade at. So we could certainly go ahead and trade something that's right at the money. And let's get into some of the details here. Obviously, whether you're trading the stock or you're trading the option, there's a bid and there's an ask. Okay, bid is what you want to sell it for, and ask is what you want to buy it for, obviously. With an option, in terms of Apple, we say they have tight spreads. We're trading here within a bid-ask spread of about 15 cents. We can sell it for $3.90 and we can buy it for $4.05. Normally, Apple trades during the day, if we were actively trading, probably with a 5 to 10 cent spread. And that's considered a very tight and reasonable spread. If you were to trade the SPY, you can usually get spreads that are as tight as 1 or 2 pennies. And that's as good as it gets. And so what you have here is a very fair market in terms of buying and asking. It's not unreasonable. And I want to add one more column here. So I'm going to take out, I'm going to change the column. Change that probability in the money, and I want to customize. I want to add open interest. There we go. All right. So the bid is $390. The ask is $405. And this particular option has about 4,465 contracts that are currently open. Now you'll notice that the 112.50 call has a heck of a lot more open interest. And that's probably because the 113 strike was a strike that was created after the fact. When the exchange opens up a weekly option series, or they open a monthly option series, just recently the January 2023 options were open. So you can go out all the way 839 days to see what options are trading at. But as options expiration gets closer for any particular expiration or series, the exchange might choose to make more strikes available. And the fact that the 113 calls only have an open interest of 4,465, which is more than enough, just means that they haven't been around as long as some of these other ones that have 60,000 open interest, or the 112.50. And the 112.50, because of the 4-for-1 split, was basically a probably a $440 or $450 option, if I'm doing my simple math correctly. This particular option that we're talking about, the 113, has what's known as a 50 delta. And I'm going to come back to this in a second and talk about delta and in terms of volatility and probability of in the money. But let's just talk about this. Whoops. That was my daughter wishing me a good class. So let's see here. So I want to go back to the slides for a second. Okay. And talk about at the money, out of the money, or in the money. So an at the money call, we talked about Apple is trading at 113. Yeah, I can't draw very well on the screen, but okay. So at the money is the stock price. So the money is the stock price. So at the money for Apple at this particular moment in time is 113. So an out of the money call is where the stock price is below the strike price. So in this case, an out of the money call will be anything greater than 113. Okay, which means that if we're talking about $114 or $115 call, they are out of the money. They have no real value. They have no real value relative to Apple's price. All that there is time value. So if an option has no real value, the entire amount of the cost of the option must be time value. An out of the money put is where the stock's price is above the strike price. Again, real value is zero. So when we're talking about a put, we're talking about an instrument that says that I want to sell a stock to someone. I have the right to sell to someone the stock at a particular price. So if Apple's trading at 113 and I buy a 110 put, well, that 110 put is below where it's trading at. It's below the strike price. So that would be out of the money. So intrinsic value is zero. All the value of this 110 put would be pure time value. And in the money call, the stock price is above the strike price. So we do have some intrinsic value. So if we were talking about 110 call instead of the 110 put, well, that 110 call would be in the money because Apple is trading at 113. The call is at 110. It means that that particular call has at least $3 of value and probably has some time value left in it. So that call, we say, is in the money. It has positive intrinsic value, and that intrinsic value is at least, well, it is $3. An in the money put means the stock price is below the strike price. So if I had a 115 put, Apple is trading at 113. What that means is that I have at least $2 of intrinsic value. Why? Because with Apple selling at 113, I have the right to sell my stock to someone for 115. So if I can sell my stock for 115 with Apple trading at 113, I at least have $2 of value in that put, plus any time value left in that option. Hopefully that makes sense. Okay, I'm going to try to, all right, let's try this again. I'm going to try to bring up the chat here, see if there are any questions pending. Okay, I don't see any questions, so I'll keep going. All right, so this is kind of explains everything that I just talked about here and kind of is a good memory jogger for you, something, a reference thing to come out of, to remember what's at the money, what's out of the money, and what's in the money. And this was, for me, at least in the early stages of understanding options, probably the hardest part to understand, but don't worry too much about it. You'll get the vernacular, you'll get the language, and this will become old hat to you once you've worked with options for some amount of time. But just remember that something that's out of the money has no real value, no intrinsic value. Something that's in the money has some intrinsic value. Whether or not it has time value depends on how far deep in the money it is and how much time there is to expiration. Little time to expiration could mean very little time value or little and mostly intrinsic value. Or if it's totally out of the money and you're at expiration day, it may have a penny or two of time value, but by the by the time expiration date concludes, you basically, if you have an out of the money options, it's pretty much worthless. Okay. So time value, as we said, is the value of an option over and above its intrinsic or its real value. Generally speaking, the more time before expiration, the more volatile the underlying stock, the higher the time premium will be. And we're going to talk about volatility in a second. This is kind of where we transitioned off last time. Time value, obviously, if you're farther away from expiration, it's going to have more time value in it. And as you get closer to expiration, time decay sets in, and every day you get closer, you lose some of that time value. So we're strictly talking about options that may or may not have some intrinsic value, but still have some value because there's time to go before expiration. Okay. So when you buy an option, the clock starts running. It basically says, okay, I'm buying an option that's 14 days out, it's out 16 days out, it's 3 months out. And every day you own that option sees a dwindling of that options premium. Okay. So another word for time decay in options lingo is theta decay. Okay. Time is your enemy if you own options, if you bought the options. And time is your ally if you sold the options. You want those options to decay as fast as possible if you sold them, so you can keep the money that you pocketed for selling them. When you buy an option, you want to quickly get that stock to run up before time runs out, and that time decay works against you. And every day is working against you in terms of the clock running out as you get closer to expiration. And so theta decay or time decay, how does that work, and can you really game this thing? And the short answer is many people have tried and many people have failed to try to figure out exactly how time value comes out. But mathematically, time decay comes out, or options decay, at the square root of time. All right. And you can see the little graph here, basically the percent of premium remaining as you get closer to expiration. You can see how, as some people say, the wagon wheel runs fastest towards the bottom of the hill. And generally, when you're 3 weeks out or less from expiration, that's when you're going to get your most time decay. So if you're looking to put on a position or buy options, you want to at least look out 4 to 6 weeks to give yourself enough time to be right. If you get into within 3 weeks and you own a long option, time decay is going to go a lot faster, and you're going to lose value a lot faster than you might otherwise see when you have a 3-month option or a 6-month option. Now, let's say you bought an option in Apple and you paid $3 for it. Yeah, I can, right. And it only has 30 days. Okay. Well, does that mean if you bought an Apple option, let's say it's a 110 call again, and it was 60 days out, does that mean the option 60 days out would cost $6? And the answer is no. I mean, would it cost $9 if it was 90 days out? Again, the answer is no. So think back to your algebra courses and remember that even though this option 30 days out costs $3, an option 60 days out might only cost $4.50. And the option out 90 days might only cost $5.50. And I'm just making these numbers up to tell you that options decay or options decay at the square root of time. And you don't need to know this or understand this or what have you, but just know that, you know, the longer you go out on time doesn't mean that the cost of the option is linear. If you really want to figure it out, if you're, say, going out 36 days, well, the square root of 36 is 6. So maybe the option is going to cost $6 or what have you. So I kind of screwed up the math there, but what you need to know is that just because you're going out double or triple the time, the option doesn't cost double or triple. And the square root of time is what kind of determines when it decays. But trying to figure out when time decay comes, I mean, everybody tries to game options over long weekends and sell options on Friday. And, oh boy, I'm going to get 3 days of time decay in my favor if I sell these options. And most of the time, it's a losing game because you never know when that time decay is going to come out. The time decay may have already come out ahead of that weekend or before. So don't try to play that game. It's a losing game. Okay. So I tried my own example. Here's the example. Option for 1 month costs $1. Holding the option for 2 months might be only costing $1.41. So it's $1 times the square root of 2. Or an option for 3 months might be $1 times the option square root of 3, or $1.73. So theta is a measure of an option's sensitivity to decay, and you will see this option. This is one option Greek to learn. Theta is basically time decay, and it's a measure of its sensitivity to time decay. And we'll be covering that in a future session, a little bit more detail. Okay. So the next part of this is, okay, what determines a lot of the options value? Okay. We all have heard or learned or talked about volatility in one way or another, and you hear it ad nauseum on the financial news and quoted everywhere you go when anyone talks about the market. But volatility obviously is a measurement of the amount by which the price of an underlying security is expected to fluctuate over a given period of time. So if a stock moves wildly, take for example Netflix, you're going to see higher volatility. All things being equal, the more volatile a stock is, think an IPO, think something like a solar stock, something that tends to move wildly, Tesla, another example, Beyond Meat, other example. These stocks that run up fast and run down fast and basically can whipsaw you even in the time frame of 1 day, usually have higher volatility and have higher option prices. So, but when it comes down to it with options, what it comes down to is, yes, a stock or an underlying might be volatile, but what affects the volatility that is priced into options? Okay. And that really comes down to supply and demand. So most people equate volatility with lower prices. Oh, the volatility is jumping, so must mean the market's going down. And so if you take the example of Tesla, where it was running up continuously between August and September, or through August into September, what you probably noticed is that, and if you were looking, that even though Tesla was going up day after day after day, and a lot of other stocks for that matter were going up day after day, their implied volatility was going up. And it didn't mean that a lot of people were buying puts, because a lot of people think, all right, volatility is going up, they must be buying a lot of puts on the S&P 500. So that would imply that if the volatility was going up on Tesla stock or Tesla's options, that they must be buying a lot of puts on Tesla. And fact of the matter is, what was happening with Tesla during the majority of August is that people were selling the puts to buy the calls. And so when you're thinking of implied volatility or volatility in an option, always think of it in terms of supply and demand. So people buying calls in Tesla or buying calls in Netflix or Apple or any other underlying can jack up the volatility of the options or the stock just as much as buying puts does. So what was happening is people were coming for Tesla options. They were just getting more and more expensive as more volatility was getting pumped into them. And so what you need to know behind the scenes is happening is that you have a market maker that's out there who has to make a market in Tesla calls. So every time he sells a call to you, you buy a call, you pay 20 bucks for it. Now he's short Tesla calls, and he's on the hook for them. Or it could be someone on the opposite side of the trade who's selling those Tesla calls, maybe foolishly, maybe not. The market maker, however, what he has to do when he sells those calls to you, he has to hedge his position. His aim as the market maker is to make money off the bid-ask spread. So he's selling them to you for 20, and he's buying them for 19. So to make sure that he stays market neutral, every time that market maker sells a call, he has to buy stock to hedge it so that he doesn't become overly short. And by the same token, every time you buy a put and he has to sell you that put, he has to sell stock to hedge that position so he doesn't become overly long Tesla or overly short. And so that supply and demand pulling and tugging at a particular option can also increase the implied volatility of that particular stock or underlying. So although options prices are dependent upon implied volatility, and looking at the prices of the option can tell you, and it takes a little time to kind of get a feel for it, but after you've been trading options in a particular underlying, you kind of get a feel for whether options are expensive or not. But until then, I'm going to show you some things to look at on the platform to help clue you in to whether you're buying into way too high volatility and you have little chance of making money, or whether it's a fair bet to buy that particular option. And even though the implied volatility may be up or down, it doesn't tell you what direction that's going to go. So let me kind of lay this out in a little bell curve, and then I will switch over to the platform and we'll get into a particular example as we talk about buying calls and buying puts and selling calls and selling puts. So you've got the little bell curve, and when we talk about volatility or we talk about any implied move in the market, we have to have some standard for that implied move. And in talking about stocks and stock funds, we talk about standard deviation, okay? And if you reach back into your statistics class, when you look at a bell curve like this, what we look at, we call these kind of the tail end of the curve events. The further out in terms of probability, in terms of likelihood, the smaller the probability of them happening. But where I drew my goalposts, if you will, is a 68% range of that curve. And that's basically one standard deviation, okay? So if you remember nothing else about this discussion, is that probabilities in terms of options starts with one standard deviation. So when we start looking at options, I want to know within one standard deviation, what is my probability of being right? Okay. So one standard deviation, let's say Apple is at 110, okay? And we have 20% volatility, all right? So at 20% volatility, all right, there's a 68% chance that Apple could be at what, 130? The 110 plus 20%, if I did my math right. No, 132. Okay. And, or it could be at 88. So when we look at implied volatility and probabilities, the bell curve would tell us that within one standard deviation, Apple could be at 132 or at 88. So this is the lower end of the range. This is the higher end of the range. And that's one standard deviation. And this gets us to another Greek that we're going to talk about is delta and probabilities. And I'm going to show you that on the platform. It's a lot easier. So when we're looking at volatility, if we see volatility of 20%, it says that there's a 68% probability that Apple's going to trade anywhere between $88 and $132. Now, if you want to get further out on this bell curve, let's say 2 standard deviations. I'm back to not being able to draw. That's supposed to be an S, not a 5. Okay. 2 standard deviations is a 95% probability. Okay. And so when you're looking at more tail type risks and you go out 2 standard deviations, and that means that we're probably going out 40%. That means that there's a 95% probability, if it's 2 standard deviations, that Apple is either 40% higher or 40% lower, okay, than where it is now. So let me switch over to the platform. And before I do that, let me just check if there's any questions. Nope. Okay. Everybody's good. All right, we're back to Apple. And so most of the math that we've talked about, and let's try to put these concepts into practice and understanding. A lot of the math and a lot of the things we talk about, the platform makes available to you right away. So if you look at each option, let me put on my little drawing tool, you can see that that particular series has an average volatility of 44%. Okay, so you know the implied volatility is 44% for this coming week in Apple. And that gives you a range of +5 or $5.49 for the week. So what this is implying is that Apple could be up $5 for the week or could be down $5 for the week. And that's one standard deviation measurement. So there's a 68% probability that Apple will be either up for 550 or down 450 for the week. So in addition to having that particular volatility, and I want to pay attention to the regular October expiration coming up in 13 days. So in that case, we have a 68% probability, and that's actually 68.2%, if you want to be totally accurate, of being up 7.964, $7.96, or down $7.96, within a 68% probability. And the implied volatility, as you can see, is up a little bit slightly higher. And that's also a factor of having more time for things to happen, more so than not. But one little tip to have is, okay, if we look down here on the 23rd, it goes up slightly, but all of a sudden on the 30th, implied volatility goes up to 50.25%. Now, 1 percentage point change in implied volatility can have a dramatic impact on the price of an option. Let me say that again. Even 1% extra volatility can cost you extra money and can make the difference between making money and losing money on an option. It's that important. So you might say, all right, well, this week Apple has an implied volatility of 44%. Going out to October 30th, it has a 50% volatility. Well, that's only 6%, big whoop. And I will tell you, big whoop indeed, because what's coming up the week of the 30th of October? Probably guessed it, Apple earnings, all right? So because we have a binary event, earnings, options have more uncertainty around them, and so the implied volatility goes up. And as you'll see, you're going to pay up more money for those options if you want to trade Apple earnings, okay? Anything before that, it's still sub 50. So let's stick with options expiration for the moment. Okay. So let's talk about buying a call, and somebody is saying, finally, we're getting to actual options trading. We're back to the 113 call on October 16th, right? Bid-ask spread, 390, 405. The delta is 50. Now, what the heck is delta? Okay. Delta is the sensitivity of an option to a $1 change in the underlying. Okay. Now, that's its simplest form. What does that mean? And delta is one of the first and most important things. If you can't find delta on your trading platform, you need a new trading platform. It's the most basic of things that you need in addition to open interest and volume, okay? I would say 99.9% of the portfolio of the platforms have it, okay? Delta is the sensitivity of the option to the underlying price. So here we have Apple trading at 113. And if I'm going to go out and buy a call on Apple for 113, this has a 50 delta. Now deltas can vary. I'm going to open up more strikes here. See if I can get 100. And you can see here they're quoted in decimals, and I'm going to need more. All right, maybe even 250. All right, I'm just going to do them all. And something is not right here, and it's probably because the platform is offline. What I was trying to get to is that if you're looking at an Apple call at a 30 strike, this delta should be 1. meaning that this particular option, so deep in the money, should move in lockstep with the stock. Here it's showing an 85 delta, which means that technically it means that this option will move up or down with Apple's strike price, 85%. So if Apple moves up $1, this should move up 85 cents. If Apple moves down $1, this should move down 85 cents. But technically this should be displaying 1, but I think it's because we're on off hours. So let me shrink down the number of strikes again and show us something more reasonable. All right, so let's get back to the 113 call. This one has a delta of 50. All right, so delta is the sensitivity of an option price to movement in the underlying stock. But for the poor man's trading platform, it's also the probability of making money on this particular option. So remember what we said about the 113 call. It is right at the money, or right at the price where Apple is trading. We're going to have a 50-50 shot, if we buy this call, of making money on this option. So delta can be equated not only with the sensitivity to the movement in the stock price, but it can also be equated with the probability of making at least 1 penny on this option. Okay. What the Thinkorswim platform also provides you with is kind of a more sophisticated calculation of probability of ITM, or in the money. So you see here that the program calculates that the exact probability of being in the money is 46.47%. And some trading platforms have this and some trading platforms don't. But if you don't, the delta is a good approximation of what your probability is of making at least 1 penny if you buy this option by expiration. All right. So let's get into this a little bit further and talk about, all right, break-even price. So Apple's trading at 113 and you go out and buy this 113 call. If you buy it, you're probably going to pay at least $4 for it, or $400. Okay. When you're bidding on an option price, most platforms will give you the bid ask. And I always start at least at the mid. Now, there's no rhyme or reason or magic or requirement that the market maker accept your bid right in the mid. But there's no rule that says that you have to pay the auctioneer what he's asking for a particular item. Okay. If something is in high demand, you're going to pay up for it, and you're never going to get filled at the mid price. But I always start my bidding somewhere between the bid and ask. And sometimes if I don't care if I get filled, I'll even put my order out there for less than the bid and wait to get hit. Especially if I think that the stock has already run too far and I don't want to pay more than X for a particular option. But if you're wanting to get into the trade with this particular option, you could start at 395. So even though it doesn't display it here, you can type in 3.95. Say, I want to bid closer to the bid than the ask. And you may or may not get filled. And sometimes the platform will fool you. It'll make you think that, oh, you can only bid 4 or 405. Most cases, even though that some options trade in 5 or 10 cent increments, you can input your own price. If the exchange doesn't allow it, it'll reject it, but it doesn't hurt to try. If you're in a hurry for a trade, most people will go and put a market order on an option. I almost never put a market order on an option. You can get ripped off, and it's a recipe. And most liquid stocks, it's okay. You won't get hit too badly, but in an illiquid stock, you're going to get ripped off. So if you're a beginning options trader, never, never, ever, not ever put in a market price for your option. Always use limit orders. If you want to put a market price, then just say, put a sucker sign on your back because that's what you're signing up for. All right. So when you decide to buy this option at $4, let's say that's what we're going in with. $4 is the price you want to pay. First thing to determine now is what's my break even? All right, where do I need Apple? The delta or the probability of in the money says I have a 46% chance or a 50% chance of making money if I buy this option. What is my break even point? Well, I'm buying the 113 strike in Apple. I'm paying $4, which means I really need Apple at 117.01 to make that first penny of money, right? Because I'm buying the 113 strike. I paid $4. 113 plus the 4 is 117. So I need Apple above 117.01 at expiration in order to make money. At least 1 penny by expiration. Okay. So thinking in that way, the automatic question should be to you, well, what are the odds that Apple will be at 117 by expiration? Well, guess what? It's not 46%. If I want to make money, this is telling me the chances of Apple getting to 117 are only 31.63%. Okay. Now, keep in mind, this is if you decide to keep this option through expiration. Most people don't. Most people are either looking for an intraday trade or a short-term few-day trade, and they buy and sell their options constantly. So 99% of people aren't looking to exercise the options that they're buying. They're looking to flip their options. But if you're looking for whether a trade is 2 weeks out or 2 months out or 3 months out, you need to understand that the probabilities of you succeeding here or getting above 117 by October 16th expiration are a mere 31.63%. So you might say, well, how do I put the odds in my favor? And I'm going to tell you, and maybe disappointingly so, okay, let's go and buy the 105 call. Looky here, I've got a 71.48% or 75% probability of making money on this option. I'm going to do this all day long. I'm putting the odds in my favor, and that's the right approach. And that's the right approach, especially if implied volatility is really high, to go and buy a deep in the money call. But if you're planning to hold this for more than a day or two, you better know that, okay, I'm paying $10 for this option, or let's say $9.55 is the mid price. This is an option that's in the money by, well, Apple's trading at 113. We're buying the 105 call, so it must have $8 of real or intrinsic value, because Apple's worth 113. I'm buying the 105. The difference must be real value. Okay, so bring out my trusty calculator. I can do the simple math. I'm going to pay $9.55 for that option. And my real value is $8. So the time value in that option must be $1.55. That's what I'm paying for in this particular option. $9.55, the cost of the option, minus my intrinsic or real value. So this is what I'm paying for time. But guess what? Even though I have a 75% chance or a 71%, depending on what number you pay attention to, of making money, it doesn't guarantee that I am going to make money just because I'm buying a more expensive, deep in the money call. What it does mean is, all right, I'm paying 9.55 for that option. And to be right, I've got to add that 9.55 to the 105 strike. My break even on this option is $114.55 because I'm buying the 105 strike right there, and I'm paying $9.55. So what are the odds of Apple getting to $114.50? Guess what? It's about 42, somewhere between 42 and 38 and 39%. Because if I'm going to make penny one, Apple's got to be trading at $114.55 before I make the first penny on this option I'm buying. Again, by expiration. The bottom line here is that when you're buying a call, if you're looking to hold through expiration, you are never, ever, not ever going to get better than a 50-50 shot at making money. And that probably comes as a shock to some of you, but it is true. You can go as deep in the money as you want or far out as in money. You are never going to get to a better than 50% probability of making money by buying a call. And the same goes for buying a put. And I'm going to explain more about that after the break. I see some questions there. So I'm going to pause for a minute. Let's take about a 6-minute break, come back at about 11:15, and then I'll answer questions and I'll get into this a little bit more, okay?
This conference will now be recorded.
Okay. Thanks, Rob, for answering the question about the standard deviation. Perfect answer. So appreciate you taking that one. So I think that answers that one. And then, yes, to answer the question about the open interest on the 113 call, it does meet my criteria. I want to see at least 150 contracts. And this one has 4,465 contracts open. So it definitely does meet my criteria. Okay. And so when we're looking at these probabilities, let me move this out of my way. You know, keep in mind that, you know, these deltas or probability of the money, this is within one standard deviation, meaning obviously Apple can do whatever it wants, Tesla can do whatever it wants, but these are probabilities of happening in terms of normal distribution. So when you look at the monthly options, plus or minus 7.96, or let's say for all intents and purposes, $8, of it moving $8 in the next 13 days, up or down. Obviously, Apple can do whatever it wants, but 68.2% of the time it's going to stay within this range, plus or minus. And so everything that we look at is based on probabilities, and this is going to give you your most bang for the buck, at least within one standard deviation. And if you're going out 2 standard deviations, then you're going to capture 95% of the probabilities, but chances are very unlikely to happen. All right, so let's go back. So we talked about buying a naked call. Let's go and talk about selling a naked call and kind of flip that on its head. So you want to turn from being an option buyer to an option seller, because I just told you that no matter which call option you buy, and the same is true for the puts as well. No matter what put you buy, you're never going to get better than a 50-50 shot at being right. And when you think about it, the underlying, when you buy a stock, you have a 50-50 shot of being right. As soon as you buy that stock, it can go up or it can go down. Sure, it could stay the same, but that doesn't happen too often. So while the options give you a little bit more control or granularity over what you're buying or selling, in the long run, options still give you a 50-50 shot at being right. So, and if the odds aren't so good when you're buying an option, how about when you sell an option? All right. So Apple's trading at 113. You decide, I don't think Apple's getting to 120 by expiration, because if I look at where Apple's trading, that's 113. The implied volatility tells me that Apple's not going up much more than $8. So let me stretch this out a little bit just to give us a few more strikes. If Apple's only going up $8 at most by expiration, if I go out, let's say let's try the 121 calls. Well, that's certainly outside the expected range. If I sell this option for, say, $1.11, I'm going to collect $111. And I can do that. I can be short one Apple call. And I'm going to just bring up the confirm and send to show you some of the thing that, oh, darn it. Better change the account. Let's take a look at what the order status dialog says. We're selling one Apple call at $1.11, which means they're going to deposit $111 in my account immediately, less the 50% commission. Okay, my max profit is $111 because I'm never going to make more than the price that I sell the option for. Okay, but technically I'm subject to infinite losses. If Apple goes to the moon, you are on the hook for whatever Apple is trading at by expiration, over and above what? Well, this also shows me my break-even price, $122.36. Well, how did it arrive at that? So let's close that and switch back here. If I'm going to sell the $121 call right there and collect $111, let's do the math. 121.25 is the strike. I also sold the call for $1.11. I don't start losing money as the seller of that call until Apple exceeds $122.36. Okay, so what is the probability of that happening? Well, let's call it $122 for all intents and purposes. There's a 16.23% chance of Apple getting to $122 at expiration. I would say if I take, okay, 1 minus 0.1623, I have an 84% chance of keeping that, at least making a penny on that particular option I sold. So as you can see, selling options puts probabilities more in your favor, which is the reason why one of the subjects we're going to talk about in a subsequent session, doing covered calls, why it's such a popular strategy to sell options on the stocks that you own. But obviously, if Apple has an event or has an announcement and pushes Apple shares up to 130, let's stretch out the strikes here and see 130. The platform tells us the odds of Apple getting to 130 are about 5%. That's not zero. This is basically probably, I guess you could say, 2 standard deviations away. And how did I calculate 2 standard deviations so quickly? So 1 standard deviation is about $8. So Apple is trading at 113. 1 standard deviation is $8, $121. And another 8 is 129. So 2 standard deviations out, I would collect 24 cents for my trouble and have a 95% chance of keeping that money. But I generally don't do 2 standard deviation trades unless the premiums are really high, because the risk reward is just not worth it. To collect 24 cents or $24, but be on the hook for multiples of that, is just a poor risk reward. I would often, though, when I'm selling calls, I'll often go just beyond 1 standard deviation and collect a decent premium. I'll do this trade on a stock like Apple, because Apple, for the most part, behaves unless there's some unforeseen event, either a collapse in the stock price or some type of out of left field announcement. But again, when you're going 1 standard deviation out or $8 out, there's a 68.2% chance that you're going to be right. But that also means that there's a 32% chance of you being wrong, and that's not zero. Okay. So when you sell that option, anytime before expiration, that option can be assigned. What does that mean? It means that that person who bought the option that you sold can come back and say, all right, you have the obligation to sell me Apple shares at 121.25. But remember, that person was the same person who paid $1.11 for that option. So chances are, unless Apple is above the break-even price, 122.32 right here, that's never going to happen, because there's no reason with Apple trading under $122 for that person to exercise their option, because it's cheaper to go out in the open market and buy the Apple shares than try to exercise an option that's basically way out of the money and worthless. Okay. All right. So let's talk about a put. Buying a put. Apple's trading at 113. You decide, I don't want any downside below 110. I'm betting that Apple's going to go down, and it's going to go down below 110. So I'm going to buy a put. What's this put going to cost me? $2.40. I've got good open interest, 60,926. And quite honestly, any of the open interest that I see here is pretty good because it's over 150 contracts. And for Apple, you'll usually see well over 1,000 open interest at most strikes. Okay. One thing I haven't touched on yet, notice that each particular option has its own implied volatility figure or calculation. Okay. What you see up here, this 45.11% is kind of the average for all the options in that chain. But you can really hone in on what the volatility of the particular option you're considering is. And notice what's happening here. And it's not a lesson for today, but you can learn a lot about what's happening by just looking, okay, if I go to the 109 call put, it has a 42% volatility. If I go to the 108, it has a 44% volatility, and the 108, 108.75, and then the 108 has 42.40. Okay, so nothing to really get into as far as what's known as option skew. That's a more advanced topic, but you know, if you're considering several strikes, consider whether going with the lower volatility option is going to work for you, because notice that you can buy the 110 option. It's more expensive, but it has less volatility than the 108 option. So units of volatility per price, so to speak, is cheaper here, even though on an absolute basis, this option is more expensive because it's closer to at the money. You're going to pay more for it. And obviously, as the closer you get to the money or in the money, you're going to pay more for that particular option. But essentially here, if I were looking at these and I would say, yeah, I want to pay a little attention because the volatility is changing. And I don't believe that these volatility figures are totally accurate right now because the market's closed. But that's something I would keep an eye on, because when you're buying an option, if all things are equal, buying the lower volatility option is going to help the potential profitability of your trade. So let's get back to the 110. I'm going to pay $2.40 for this option. Okay, so we're buying the $110 put. We're paying $2.40 for it. So my break even is $107.60. What does that mean? I'm not going to make a dime on this put unless Apple declines below $107.60. Or in this case, it's $107.50 here. So what's the probability of being in the money, or what's the delta? 26 or 28% of being in the money. So if I were to buy this 110 put between now and expiration, I essentially have a 28% chance of making money on that put. It's not 0 and it's not 50 and it's not 100. It's something. But you got to know that if you're buying a 110 call 13 days out, the odds are 110 put, I'm sorry, the odds are not in your favor that you're making money, because the probability of in the money means it has to be below 107.50 by expiration to make you any money. Now, I'll say what I said before with the call. Almost no one holds options to expiration so they can exercise them. Most people are trading 1 or 2 days worth. So you don't need Apple to get to 107.50 by expiration. You just need the option to move enough for you in a short time frame, so that if you bought this option for $2.40 and Apple's heading down for the day, maybe you can sell it that day or the next day to someone else for $3 or $4. Okay, so you don't care about expiration and these probabilities, but if you are holding options for the long term, you have to consider the delta. You have to consider the probability of the money and know exactly what you're buying, so that if you end up holding an option for a longer term than you expect, that the probabilities are in your favor. If Apple goes to 100, you paid $220 for this option. The real value of this option is 110 minus 100. So that's a $10 difference. You paid $2.40 for the option. You'll make $7.60 on that particular put. Again, you pay $10 for the option. Apple, that call now has a real value or intrinsic value of $10. You pay $2.40. Therefore, your profit is $7.60. Okay. So let's flip that on its head and say, well, instead of buying a put, I want to sell a put. I want to be the insurance company. I want to be the house. What do? Well, generally what I do is, if I want to sell a put, I'm looking to do one of two things. I'm either looking to make some money off the premium, or I really want to buy Apple cheaper than the price is trading at now. When you sell a put, you're saying, I am comfortable getting long or buying this particular stock or underlying for this particular price, and I want to get paid for it. So like the house that's burning down, or that you're insuring, or the insurance company is doing, you're paying a $2,000 premium a year, so the insurance company will pay you your full value less your deductible should your house burn down, or an earthquake destroy it, or a tornado destroy it. If you decide that you want to be the insurance company, you're saying, okay, I would really like to buy Apple at 105 per share. I'm comfortable that if Apple comes down to 105, I'm good owning it there. So I'll sell a put at 105, and I'll collect, let's say, $1.12, the mid between the 110 and the 115. All right. Well, we know that Apple is trading at, do this again, 113. The options chain shows me that Apple has, within a 1 standard deviation limitation or move, the odds of moving $8 up or down. So chances are, within 1 standard deviation, if Apple stays within its expected move, then selling this 105 call means that I'll probably keep all of the money from selling this particular put. If Apple should end up going down to 100, well, I'm still stuck buying Apple at 105. But I did collect $1.12 for selling that put, so my real cost basis in Apple is somewhere closer to 104 than 105. So I've not only reduced what I'll pay for Apple, but I've also reduced it further by the amount of premium I collected. So if someone puts 100 shares of Apple to me at 105, my cost basis is really a little less than 104. I'm not happy about it, because now Apple is trading at $100 and I have a built-in loss of $400. But I'm not crying too much, because that's the bet I made. Now, if Apple goes down to 90 or 80, then I'm not so happy about selling that put at 105. And again, when selling puts or selling calls, or buying puts or buying calls, you're not necessarily waiting for expiration. And so here's a little tip. When I sell puts or I sell calls, I'm generally looking to get $1 when I do that. Anything less than $1, this also obviously depends on the underlying that you're buying or selling. So it's easy to get $1 on Apple or Tesla or Netflix or what have you, but on a $10 or $15 stock, you're never going to get $1 unless you're really close in the money or you're going really out in time. So the first lesson is, if you're going to buy or sell options, make sure you have liquidity. You have the open interest. Okay? And also make sure you're getting paid enough to take the risk if you're selling an option. So in the case of Apple, collecting $1.10 is 1% of the underlying. That's generally where I cut it off. I don't want to get any less than 1% of the underlying. So I'll either go out further in time to sell a call or put, or I'll come closer to the money when I sell it. But let's just take a look. Here, the 105 call in October, expiring in 13 days, is $1.10. If I give myself more time and I go to the November monthly options expiration, let's look at what the 105 call is trading for. Aha. So now if I go out 48 days, 35 more days, or 5 more weeks, I can collect $4.90 for that option. Okay. But also notice what's the delta here? The delta here is 32, or probability of being in the money is 39%. Okay. The odds are not in my favor as much, but I am going to collect more money. So I might just decide, okay, Apple is trading at 113. Let me pull this down. This is telling me the 20th of November expiration, the monthly expiration, has a plus or minus $17 move, 17.67. So let's subtract 17.67 from there. Apple has a 68% chance of holding within $95. So how much do I get if I sell the 95 call in November? Well, I'm going to get about $2.07. So I'm almost doubling what I collect. I'm actually tripling the amount of time, but I'm also keeping my probabilities of being assigned down to under, in this case, under 20%, 22% here. Okay, so the farther you go out in time, the more you'll collect, obviously, because there's more time value here. There's 48 days of time value versus 13 days of time value. Here, you're collecting a bit more per unit of day, but you also have a little bit higher chance of being assigned, and you're closer to where we're trading now. Here, you only have $8 to be right. Going out to November, you have $17 to be right. So those are kind of a couple of the nuances as to picking a particular put to sell in these cases. And again, if you're buying a put, even if you go deep in the money, if we go to the 120 put, and you buy that for $8.30, the 120 put minus where Apple is trading is 113, means that that put has a real value of $7. If you paid $8.30 for it, it means that this particular put has $1.30 of time value left in it. So what are the odds of you making money? If you paid $8.30 for this put, 120 minus $8.30, Apple has to be under 111.70 for you to make $1 on that. What are the odds of you making money then? 46 to 49% on this particular put. Better odds than buying the 110 put, but certainly almost a 50-50 bet. And this is one of the reasons why, unless you're doing short-term trading in options, buying options sometimes can be a losing game, and why most people prefer to be sellers of options. And you'll hear both sides either advocating or not advocating for selling or buying or what have you of options. But the key is you have to treat options as you would the stock. You have to define your risk. You know, if you're buying an $8 put, at what point do you decide that you're wrong and decide, well, I'm going to cut this short at 50% of the premium. If I lose 50% of what I paid for it, I'm going to cut my losses. What you can also do is say, well, I'm going to pay, for example, for this one, for this particular put, $5.50. And win, lose, or draw, that's the most I can lose. I'm willing to lose all that, and that's fine. You can do that because you defined your risk. You can never lose more than $550. I personally put a 50% limit on the amount I'm willing to lose on a particular option that I buy. If I hit 50%, I'm usually out. And I say usually because you know, option prices can whip wildly throughout the day, and you can get easily whipsawed. And so you do not want to put stop orders on options in the system. I don't care how you do it, mentally or what have you, putting stops on your options is just asking to be hit intraday. If you're going to follow a rule with your options to say, I'm going to cut them off at 40% loss or 30% loss or 50% loss, no matter which one you do, I think I said it last time, you are going to get whipsawed sometimes. But in my mind, they're all mental stops, and sometimes just being patient or waiting to the end of the day to make your decision to hold or cut can be worthwhile. Obviously, the first hour of the day is very volatile, and you don't want to necessarily make a decision to dump all your options if the market is dumping out first hour. You want to give it 15 to 30 minutes for things to settle out before you actually sell out an option that looks like it hits its 50% mark. So use a bit of judgment, and especially if you've defined your risk with the premium, sometimes these things can come back very quickly, and sometimes they never come back. And so make your risk decision at entry. Know how much the maximum you're about to risk. If you can save 50% of the premium, make sure that if you lost 100% of the premium, if you woke up one day and the stock gapped down, because that could very well happen, make sure you're still comfortable with losing 100% of that premium. And if you're not, find a different option to buy or sell, because it could happen. And most of the time when it does happen and an option value collapses, it's not coming back for the most part, especially if you have a short time to expiration. So what option do I choose to sell most often? If I'm looking to sell, as I said, I'm looking at options that have usually a 20 to 25% odds of being out of the money. So said it a little differently, I'm looking for, my sweet spot is about a 25% or 25 to 30% delta to sell, okay? Now, does that mean I might get hit on one way or another? Yeah, I have a 25 to 30% chance of being wrong on selling that option. But that is my go-to range. So if I see a delta of 29 to 26, I look for the open interest and assess, what the implied volatility might be, comparatively wise, comparing them, and then decide which one I want to sell. If the stock is not moving around a lot, it's not very volatile, maybe I will do a 29 delta, which means I have a 71% chance of keeping the all or some of this premium. Same goes for the call. If you've got an uptrending stock, a stock that is relentlessly going up to the upside, you probably don't want to sell calls on it. This is a stock that you don't want to chase as a trade. Selling a put can be a wonderful alternative to make money on the stock. Although you're limited to the premium that you get for selling the put, it's still making money on the stock that you wouldn't otherwise made. Because if the stock continues to go higher, you're going to keep all that money you sold from the put. But on an uptrending stock, something that's in a relentless uptrend, I do not sell calls on, and you don't want to either, because what looks like juicy premiums and nice money to collect, even going out to a 20 delta or 18 delta, you will get hit. And if you are a Tesla option seller, you got hit in August and September because it kept going up and up day after day after day. And those juicy premiums that you thought were nice to have ended up running you over, and you were paying back multiples of them. And the same can happen on the downside too. If you're in a downtrend, you can get run over by selling puts. And so when you make the decision that you want to sell options against positions that you don't have, you want to be the house, you have to ask yourself, do I want to own this particular stock or underlying at the price I'm willing to sell it? And if the answer is yes, ask yourself a second question. If this stock goes 10% below my put strike, short put strike, am I still happy owning it? And if the answer is yes, then you probably arrived at a good strike price to sell. If the answer is no, you really have to ask yourself if you've gone to the right strike and you've taken the right expiration. Remember, by going farther out in time, you're giving yourself more time to be right. The shorter the time to your expiration, the less likelihood you're going to be right and the less likelihood you are to make money. So giving yourself time to be right works on the long side and it works on the short side. So always give yourself enough time to be right. If you are new to options trading, I would advise avoiding the weekly options. One, because the open interest is not as high. Look at these weekly options in Apple. It's good open interest, relatively speaking, but still not as liquid as the monthly options. And so as a beginning trader, I would stick with the monthly expirations, the ones that are not in yellow, because you have a lot more liquidity and you have a lot more time to be right. And that's what you want. You want to put time on your side when you're buying or selling options. So talk a little bit about selling options. What about when I buy options? Where should I go? What should I do? And how should I buy? Should I buy at the money? Should I go in the money? or should I go out of the money? Okay. And the answer to that really depends a lot on the technicals of your trade and what your time frame for the trade is. Take a sip of water. So if you are dealing with a short-term trade or an intraday trade, it doesn't matter what expiration you pick. If you're going to be out of the trade by the end of the day, you might as well go to the nearest expiration. There's no point in paying for time that you're not going to use. If you're going to be out of the trade by the end of the day, use the nearest expiration, because if the stock if you buy a call or if you buy a put and the stock turns around and goes the other direction that you're expecting, you're just going to lose more money by buying more time. If, on the other hand, the technical setup is going to take a lot more time to develop and may have some backing and filling to do, then give yourself time to be right. And I generally, for a swing trade, will go out a minimum of 28 days or 4 weeks to 45 days or 48 days. So if I'm looking to put on a new trade in Apple today and it's something that I'm going to carry, first I'm going to decide whether I want it past earnings or not. Is this something I'm going to hold past earnings? If I'm going to carry it through earnings, I'm probably looking at the November expiration. Gives me 48 days to be right. I'm going to pay more for it, but more time to be right. All right. So if I've decided I'm going out in time, so what strike should I buy? Again, it goes back to the thesis and your objectives for the trade. Where do you think Apple is going? Obviously, when you go deeper in the money, you're going to increase your probabilities of success, but it's going to be more expensive. But if Apple is trading at 113 and you're expecting it to hit a target of 125 or 130, going out of the money is not a bad idea. And I know people have a lot of different theories about whether they should buy a 30 delta option or a at the money option or somewhere in between. What I would say is figure out what is going to be the total risk on your trade. If you're willing to trade, if you're willing to risk $2,000 on a trade or the maximum of $1,000, okay, obviously you could buy 2 of the 112.50 calls, but you could buy perhaps 4 of the 118.75 calls. Okay. Obviously, the further you go out on the money, the less likelihood of your trade succeeding. I generally go for, when I'm doing a trade, I'm usually going for 1 strike in the money. If volatility is really high, and I'm afraid that volatility is going to come in for whatever reason, you want to go deep in the money, assuming you don't want to buy the stock. What's deep in the money? Let's say we've just come off a big sell-off, the market's down just like it is right now, 10%, 15% correction, and you think it's time to get long, and you want to get long some options on some either indexes or particular stocks. If volatility starts to come in and it starts to come in hard and you're buying these at the money or out of the money options, it's going to cost you dearly. You just paid up for volatility, because volatility collapse happens slowly at first, and then all of a sudden, as some might say. So if you are at the tail end of a sell-off, or could be the tail end of the sell-off, you just don't know, and you want to buy some options, If volatility remains elevated throughout the market and throughout the underlyings, buy whatever the heck you want, but you don't know that. So if I'm going out to buy options right after a sell-off and volatility is elevated, and when I say elevated, it's above 20, in my opinion. Overall, the VIX is above 20. The only way to kind of keep yourself from suffering and losing that money from the volatility collapse is to look for an 85 delta option. Okay. If an 85 delta option is too expensive for you, take less time. Let's go to the 16 August. Okay. In Apple, that would be the 98.75 call. Yeah, like I said, it could be the 99 call, or let's just say the 100 call because these numbers look screwed up to me. So let's say you buy the $100 call in Apple. You all but insulate yourself from volatility collapse when you buy them. Now, you've got an expensive option here. But keep in mind that unless Apple collapses, the price collapses down to 100, you're not going to lose the $13.80 that you paid for this option. If Apple comes in a couple of dollars, your sensitivity to the Apple stock price is going to be 85 cents on the dollar, which means that if Apple comes in $3, your option is going to lose 3 times 85 cents for every dollar comes in. By the same token, if Apple goes up $3, you're going to make $3 times 85 cents for every dollar that you're going to make 85 cents for every dollar that Apple goes up, or 3 times 85 if it goes up $3. Okay. Now, when the volatility picture stabilizes and volatility is back below, say 25 and getting closer to 20, you can go back to buying at the money or out of the money options with little fear of volatility collapse. In the next session that we have, we're going to talk about how to buy options and using spreads to eliminate or greatly reduce the effects of volatility collapse without paying up for the option. And by the way, the same thing goes for buying puts. If you want to buy a put and volatility is potentially coming down, or you just don't know the time frame of the volatility coming in or how long the sell-off is going to last, go to an 85 delta. And if the stock doesn't make the move you want on or before expiration, when you're buying a deep in the money call or put, and you still believe in your trade, just sell the put or the call and buy another one deep in the money in the next expiration to keep the trade going. And if volatility has come in quite a bit and you're not worried about volatility collapse, then you can buy instead an at the money or out of the money call. Now, what I just talked about is a bit advanced, and it takes a lot of experience to get a feel for them. So I apologize if I've kind of gotten a little bit too inside baseball here, but suffice to say that if you're new to options trading, there's a lot that can go wrong with your options selection, and I want to help you with tips with practical tips with buying options and right out of the chute and without making too many mistakes. But the fact is, the only way you're going to learn is to make mistakes. But if you're trading small, 1 or 2 contracts at a time, and you're giving yourself enough time to be right, you're not going to lose too much money. But this is how you learn. This is how the learning process happens. And if you've paid attention and a lot of what I've made sense, a lot of what I said has made sense, then you're going to avoid a lot of the mistakes I made by not buying illiquid options, by not paying up for increased volatility and being suffering from volatility collapse. And if you're a new options trader, I would say stay away from trading options for earnings, and stay away from them anyway because it's a binary event and it's a coin toss. So what you want to do is take your time and look at what you want to buy or sell. And if you want to try something, go ahead and just stay small. Know that, when Apple reports earnings, up until that moment that they report earnings, these October 30th and later options will have elevated volatility. You can see 50.3% here, 52 here, 50 here. It stays elevated through a few expirations afterwards. But that volatility will come in. So always factor any binary events coming up, whether it's earnings or an FDA decision on a biotech or what have you, and know that once Apple reports earnings, those earnings are out, a lot of the air is going to come out of the options. So if you're holding those options and they're not deep in the money, you're going to lose money on them. So you either close them out before earnings, or you make damn sure that you've got a deep in the money call that it's not going to suffer from that collapse. And of course, if you have a deep in the money call and you're wrong about Apple's earnings and Apple drops, you're going to lose that money anyway, because whatever the stock value loses, that option value is going to lose it very close to the same amount. Okay, let's take a look here. If I got through the slides I wanted to. And I think so, yeah. So I'm going to pause right there so that the next time we can get into spreads and start using strategies and covered calls as they are to eliminate the effects of volatility and really use these strategies to help make money. So I'm just going to look. Can everybody still hear me? My screen is on. Can everybody still hear me? Okay, Marvin can hear me. Maybe George lost his connection. So let me scroll through here and see some of the questions. When you're buying weeklies, what is the decay formula from Monday to Tuesday, Thursday to Friday? Honestly, I don't know the answer to that. I believe that it's, if anyone knew that answer, they could game it, and there's so many factors in it. I don't think anybody knows what it is. Sometimes when I look at Amazon options or I look at Apple options, weekly options, depending on what the stock is doing, it holds all of its decay and it doesn't come out till Thursday or even Friday of the week, weekly. So very hard to tell what the decay formula or what is happening. Again, the square root of time is the operative math that's involved, but whether you're thinking volatility or decay is going to come out Thursday, Friday, or Wednesday, nobody really knows, and it depends on what's happening with that particular underlying. Probabilities change quickly. Yeah, they can. So it really depends on what's going on in the overall market, what's going on with the company, with the underlying, and those deltas can change. And obviously, if the price of the stock changes, going up or down quickly, the probabilities and the deltas change very quickly. So you might have bought a 50 delta option, but by the end of the day, you could be owning a 30 delta option or a 70 delta option, depending on which direction the stock moves, and depending on the overall volatility of the stock. So can you use stop orders on options? Absolutely, you can use stop orders on options. I don't recommend them. You will get whipsawed, and because the prices move around so many times, and I had to learn that the hard way a few times. And so if you're putting on options and they're not long-term options, you better be paying attention to them, or you probably shouldn't be putting them on. So. All right, I have my screen up. Well, what part of my toss screen do you want to see, Marvin? Did I miss anyone's questions? Excuse me. Yeah, selling a call in a high volatility environment is desirable, and volatility is usually going up as the market's falling. So we do like selling calls into higher volatility. So it works both on calls and puts. So yeah, we do want to sell calls into higher volatility, and I do that all the time. I guess I'm not asking, can you share your screen, your toss screen? I'm not understanding your question, Marvin. There is a way to share in toss. Share with whom and how? I guess I'm not understanding what you're trying to say there. I apologize. All right, while we're waiting for any last minute questions, I want to thank everybody for attending. And the next one that we'll do will be after, probably today is the 3rd, 3 weeks from today. So we'll get into spreads, we'll get into covered calls, and then from there we'll see whether there's anything else that needs to be covered. If you have any questions, email me. I'll put my email address in chat. Don't put this on the webs. The recording will be made available in a day or so. And again, any questions that you have, feel free to send to me. And have a great weekend, everybody. Take care. Bye-bye.